All right, welcome to tonight's webinar. Thanks for your patience. Like I said, if you didn't hear me in the beginning, I kind of goofed a little bit because I forgot to take off the password for tonight's webinar. Because tonight is not just a members-only webinar; it's open to the public. So thanks for your patience for the last couple minutes. I am recording the webinar, which I know will get the question. But last 2 weeks, so trying to get into the habit of giving a little bit more webinars, especially I think just Wednesday night will probably be the for the most part the night where we give weekly webinars. And last couple of webinars we did cryptocurrencies 2 weeks ago, which was awesome. Just really a full understanding of what cryptocurrencies are and so forth. So we did that 2 weeks ago. And then last week, we did a webinar on value areas. So we really kind of went into some. Ooh, All right, I must have put myself on mute. Thank you for attending tonight's webinar. If you missed what I said in the beginning, my screw up earlier, I must have went ahead and put a password protected on the webinar, so so people can we're having trouble getting in. So I had to go ahead and take that off. So sorry for the delay. Thanks for attending tonight. So just getting into a little bit more of habit for for the last couple of weeks, we've been giving webinars on some pretty in-depth subjects. And 2 weeks ago, we did one on cryptocurrencies, which I thought went extremely well. We covered a lot of topics in the cryptocurrencies, kind of the history, some basics, how to set up an account, and all that stuff. So I thought that was really good. We had Web Begol on 2 weeks ago, and as well as last week, he joined for last week's webinar because we went in detail about value areas and why I use them and so forth. So we have those recordings. Those are on my YouTube feed. I thought those went really well, but there were some pretty in-depth subjects. So tonight, I just wanted to kind of give a recap of the markets, which I like to do. I generally give a video after the close and kind of talk about the markets and the option activity, but wanted to give more of a little bit of a summary. Kind of talk about what we do on a day-to-day basis. We've had some new members come in, so I just thought it would be a kind of a good idea just to talk about. I know a lot of people when they come from other places, they've either watched option activity, reading the tape a little bit, but I put a little bit of a different spin on it. So I wanted to talk about that in general for a few minutes and also just kind of give the state of the market, right? Because, option activity, that's not the only thing that I rely on, and it's a kind of big disservice. Like if you've ever been in another room, that's all they do or that's all they talk about. There's so much more to that. It's just kind of a piece of the puzzle, and I would say option activity is probably when I take trades, basically how I use it, and was talking to a member about this. It was probably about a month or so ago, and they were new to option activity, and we were watching. There was one, there was like a weekly call buyer or front month call buyer, and I went and I purchased December or January calls, and they're like, why would you do that? They purchased October, or they purchased September. And I'm like, well, I don't care what they did. It's different if it's a really illiquid name and the options are just not going to be very, or only going to be liquid for that strike and that expiration. But if it's a pretty liquid option, I was expressing to this new member. I said, I'm just looking for ideas. Like, I don't really care, if so and so bought the calls and they're going to make it up. I mean, basically, we're just looking for really just trade ideas and some momentum. I mean, if somebody comes in a couple times and purchases the same name, that really gives us a good sense if they think it's going to move. So really, option activity is kind of twofold. It's looking for trade ideas, and it's looking for momentum in some things. I mean, some things they could be a great setup, but or they might look pretty good. The stock might look pretty good, but it just doesn't move. So really, once you start to see the aggressive call buying, that really helps with kind of catching momentum. But once you get into the trade, you're basically on your own. So if you're looking for an idea or a signal, because they're not going to call you. First of all, you don't know what their position is, right? So you really don't know altogether what they're doing. So then it really becomes your the ball is in your court for how you're going to manage the trade. They're not going to tell you that they're trimming the position, or that they may be they may hedge out with something else. So so this was a nice conversation that I had about a month ago, and trying to just educate and say, hey, they're not going to call you and tell you when you're out of the position. So it's really up to you to manage the position, because as we know, not every trade that hits the tape is going to work. There's some that's really pop and they go very well off the bat, but there's others that you could be in the trades for a couple weeks or sometimes a couple months, and then it starts to work. So you have to define these things, and sometimes you sit in one of these trades that you see aggressive option activity, and the signal looked great, everything that you could see repeat activity, and it doesn't work, and you lose a whole bunch of money, and the price breaks below trend, it breaks below support, and if you're still in that trade, they're not going to give you your money back. So and then the other thing that I always come back to is you have to realize who's buying the options, right? I mean, look at the performance. I mean, there's certain guys who do very well. There's certain hedge funds that do very well, but just look at hedge fund performance this year, and most of them are not beating the S&P. So you kind of have to go back to that and say, yeah, I'm looking for ideas, I'm looking for momentum, but the guys who are buying it, if that was the case, then their performance would be tremendous, every time. So I think that's also a thing that a concept that gets lost is that you have to come up with your own trading plan, because just because somebody's buying it and it's aggressive, it doesn't mean it's going to be a home run, and it doesn't mean that they're going to be right. So that's kind of what we're going to go through tonight. We're going to talk about some kind of a recap of this week's aggressive activity, a little bit from last week as well, because I think last week carried over to this week. Just going to talk a little bit about what's interesting in the market right now, kind of where we are, and then if we have time, I always feel like I try to bite off more than I can chew in these. I put two subjects in this, so we'll see how it goes, and then of course. If there's questions as we go along, I think that worked really well with the last couple weeks of webinars. We kind of really had some good engaging questions. So, by all means, this is not a lecture. So, if you guys want to look at charts towards the end, or if you guys have questions about any of the concepts that I'm going over tonight, that's really, you want to get out of as much as you can. So, ask away questions. So, of course, the risk disclaimer, it's on basically everything that you're going to hear through tonight's webinar, or through tonight's presentation is information only, no advice, no recommendations, anything like that. So please go ahead and read through this. My background, most of you I see some handful of members in here tonight. They hear me all day long, so they of course don't have to listen to me again. But it looks like we've got some outside people. So in case you don't know me, I'm the CEO, founder of the Tribeca Trade Group, which I started back in the springtime of last year. So my background is I was an institutional trader at Bank of America Merrill Lynch, so Merrill Lynch before it was taken over. But I really, a lot of my trading that you find that I do on a day-to-day basis comes from my background. I traded ETFs. I traded a lot of index products. I was on the Delta One trading desk. Delta One, I always get the question, what is Delta One? It basically is just one for one. So like a package, like an ETF is really, when you think about it, an ETF is really a derivative product. It's made up of, it's one thing, but it's made up of underlying things. So for example, the SPY is made up of 500 names. XLF is made up of financial companies. That's all it is. So, but it's one thing, and it's made up of sum of parts. Just like with a bunch of other indices as well. If you used to trade indices on swap, an index is one thing, but it's made up of a bunch of parts. So delta one. What I also did is traded a lot of international, which is really kind of helps me and gives me perspective of how international markets work. And I really find that most since I've been kind of on Twitter for the last couple of years, I really see that most people are most and there's a lot of good traders on Twitter, so don't get me wrong, but a lot of them are just so focused on domestic names and they really don't pay much attention to what's going on internationally. And we hear this on CNBC. Listen, I listen to CNBC. I like a couple of their programs, but they spend so little time talking about what's going on outside of the US borders. So that experience of trading international for a couple of years and understanding international markets really gives me good perspective. And then kind of going back to ETFs and why I really like ETFs is ETFs allow you to access every part of the market. So, as much as, again, there's always debate on Twitter or on financial media about how much ETFs have taken over. I mean, listen, these products, like, to get into, Germany, either currency hedged or non-currency hedged, to get into frontier markets, basically anything that's trending around the world. If you're a trend trader, which I consider myself very much a trend trader. If you're a trend trader, you have to love ETFs because they get you into anything that's trending around the world. So, very, very passionate about the product because without them, you as a retail investor, you couldn't get into these areas. Besides just trading some ADRs. So anyway, that's my background. So I traded. I basically at Merrill Lynch, I traded just about every product on the equity trading floor, programs as well, and a number of other things. But I want to get to the presentation. My Twitter handle is @CFromhertz if you don't know that already. So the week in review. So just quickly, I just like to look at this just to kind of say before we get into the option flow, what's been going on for the week. So we've had a little bit of a bounce. Last week was, there was a lot of, I don't want to say a lot of fear in the market, but there was a lot of events that were going on. And by the way, I'm sure going to have some typos in here. I actually just put this together right before, after the close. But, we're up, SPY's up 1.3% for the week. IWM's got a little bit of outperformance this week. I was looking at, we'll go through some charts, as we go through here. But SPY, looking at the SPY chart, you have to be pretty happy with 52-week highs. We had a lot of chop in August. We had a couple times where we thought we were going to break down and kind of turn the corner the other way. We broke the 50-day moving average, something that we hadn't done for months. So it got a little iffy for a couple weeks. Especially some things like small caps. I'm going to show the small caps chart. Small caps broke down. And I remember giving a webinar for someone else, right when this was happening. And, I said it's kind of a warning signal, but we could get right back above the 200-day fairly quickly. And we did that. And since then, we spent about a week or so underneath the 200-day. And then since then, small caps have actually been outperforming. So, it's been a little bit tricky, I think, with the small caps and getting a little bit of a warning sign breaking the 200-day moving average. But, we've bounced back nicely. Again, last week was kind of a consolidation, but then we broke above value, we broke above the 50-day moving average. We've had 3 strong days of small caps. So, what's helped the small caps in the last couple of days? Well, a lot of people, and I always find this surprising, is same thing with the S&P. Some people think that these things are just, it's small caps, and they just think it's, an ETF or an index, whether it's futures. They kind of think it's a product one in itself. It is. You could trade S&P futures, but it's really what's going on inside. So what are the big sectors in small caps? Financials is the number one sector. there's also small cap, and energy is a very small portion of it, but it really kind of helps to look at what's driving this, not just to say, oh, somebody's buying small caps, or somebody has a bid in the futures. I mean, it really is a function of what the sectors are and what the stocks are. So believe it or not, banks are the biggest weight in this. They're 10%. So they, IWM actually held in pretty well as the banks were doing bad last week. But this week the banks are outperforming, so that's kind of giving a little bit of a tailwind to small caps. And then also you've got some biotech. You've got a decent portion of biotech and pharma in here, which has also been lifting small cap. The whole ETF as well, and also healthcare products. So you got quite a bit. Because if you add up healthcare products, pharma, and biotech, that's probably the number one weight. So. But then, just breaking it apart this way and looking at, because again, all it is function, the performance in IWM is a function of the underlying companies, right? So if the companies and if the groups of the companies are doing well, then this makes higher. But I feel like this concept gets lost a bit when people look at indices. They forget that they're just groups of stocks. But anyway, so we've had a nice recovery in this group. So moving along, and actually Qs, while Qs have been the leader all year long, it seems like a lot of other areas are doing a little bit better just this week. Just this week again, and there's really nothing. It's still up 1% for the week. It just seems like this week, a couple of days, it's trailed in performance, which is really tough to. Which is really, I guess, being really being nitpicky. I would guess. Because we're basically at a 52-week high. So we haven't made a 52-week high yet in the Qs, while we have in S&P. Let me just check my email. I just want to make sure no one else isn't having difficulty getting into the webinar tonight. So I think we're okay. Sorry for the pause, but so I mean that's been going well. I mean we're almost at the 52-week size. It's just the Qs have been underperforming just a touch. So then looking at what we have for kind of macro, bonds gave back. I mean bonds were really well bid going into the weekend. Last week they've given back basically all these the first three that I've got listed, gold, bonds, and the VIX, which all got a bid last week, have been giving back gains after the hurricane, and with no big North Korea headlines recently. Who knows, maybe we're due for another one coming up, but all of those risk off areas that really outperformed well last week have given back some gains. And then I go to international markets, and again, I've been starting to tweet out on a daily basis, something that I haven't done before, is just where the Asia markets have closed and where the European markets are at, because some of these have been doing much better. And like I said in the beginning of the webinar, I think there's just less of a focus, for U.S. investors. There's just less of a focus on international markets, and really those have been where the really strong performance has been all year long. So just this week, DXJ. Anybody have a guess why I have DXJ and HEDJ listed there rather than what's the other one? VGK or EWJ. Anybody have a guess why I have those on there? Yeah, so Bob kind of knows it's hedged, so there's no currency effect, and it's been a very big, which I'm going to come back to. I'm listing also HEDJ for a reason. HEDJ again is European stocks, and they're basically locally listed, right? So look at the difference between HEDJ, this chart, which I hope you can see, and VGK or FEZ, which is basically the same underlying stocks, But one, when you have international ETFs, unless they say so, you have exposure to the currency. So it's additive. If the European stocks goes up, plus the currency, your ETF is going to do very well. If European stocks go up and the currency goes down, then the performance is going to be flat. But you could see that Fez has done very well because the euro has been rallying as well. So again, same basket of stocks, just about. It's just about the same basket of stocks. Just one has currency and one has exposure to currency and one does not. So I'm going to come back to this HEDJ trade because there's some option activity in it, and I'm going to talk about that and the trade. And then emerging markets. Emerging markets have done really well this week. Right in line with, I guess, U.S. markets, but EEM. I mean, just look at this chart of EEM. It's been pretty stellar. And I think, I mean, this thing hasn't. Where's where's the weakness been in this thing? Here, I guess. So it's just been a beautiful trend all year long. EEM. I want to say it's up around 30% year to date. Yeah, right in line, right on the screws. I got it right. Year to date, 30%. So, and I didn't check that beforehand. So, again, you go to the U.S. market. So I'm really nailing this point home. I apologize, but emerging markets are up 13%. SPY's up 13%. So it's not that we're doing poorly in the U.S. Yeah, thoughts on the dollar reversing? I'm going to talk. Let me just go through a few more bullets, and then I'll get to that because it's a great question. And again, that's why I kind of have this listed. Whoops. So sector winners, I actually have KWeb, which is really not a sector, but we've been all over this in the trading room, trading these. And again, I think it's kind of funny when people that I think are really good on Twitter, and they start to mention, wow, look at the move in Baba, or look at the move in JD, and I'm doing the same thing. I'm trading them, but I haven't really heard too many people talk about, hey guys, it's the whole group that's moving, which is really what helps me kind of find names, individual names. But this is the China. If you're not familiar with this ETF, it's the China Internet ETF, and this thing has just been on an absolute tear. And you could see all the inflows that happened on this dip, by the way, which was really nice. This is what compelled me to get into this trade here to kind of, and it's tough, right? I mean, after a group has had, what is this one up year to date? This one is up, yeah, 65% year to date. So it's tough to like buy something that's up like 50% year to date. But I saw all this buying that was going on, even here. So I was like, hey, if somebody's buying here, and I'm catching it here, after they bought, I decided to go high, and I was a little bit scared. I put on like a half a position in the KWeb ETF. But again, it's the whole group. So Baba was a great winner today in the trading room. JD, which we got into, yesterday. We saw some option activity in that one. But just to kind of watch these, and then you can kind of go through and you could pick these individual names, but it's really the whole group. So I saw somebody tweet out, just a couple other names like Wuba and Sina. It's like, wow, these things I really picked a winner. Well, yeah, you did. But it's the whole damn group. You could pick any one out of the group, really, and you'd have a big winner. So, really, really strong performance this week. Up 4.4%. Again, you look at the relative outperformance of SPY. We talked a little bit about the banks as well. They were the underperformer last week. They snapped back really nicely. We did see some option activity last week in some choice names. And then, of course, the momentum, like Bank of America is typically the momentum type name. Whenever financials start to get going, the banks, we see all kinds of BAC orders. But last week we saw a nice Wells Fargo order, really chunky, longer dated positions when Wells Fargo was oversold. So those worked out really well. OIH energy's been strong, and I'm forgetting a percentage here, but and the robotic stocks have been really strong, even when there's been, when the market's been going down. Some of these areas have been going down, and then the sector losers. If you notice, there's quite a bit, and this has kind of been the case on a day-to-day basis, is that you look to see, I mean, like, I've got a sector watch list of about 30, 40 names, and every day you kind of look and you've got a decent amount of names in the red and you've got a decent of names in the green. So this week it's telecom, which is now for 2 weeks in a row has been getting slammed. That's the IYZ ETF. Gold miners are giving back a lot of the gains that they saw. XME, which is half gold miner or half mining and half steel names, is also down this week. Some of the steel names were down a little bit. Copper's been down this week as well, causing a little bit of move down in some of those names as well. But it just kind of goes back to, like, you look at the S&P today, it's flat. It moved in about a 10 basis point range. Why is it moving in such a tight range? First of all, and it goes back to my analysis on what we were talking about with IWM, and saying it's a function of the stocks. So regardless if somebody's buying futures or not, or selling futures, if some areas are really breaking down or seeing rotation out of one group and into another, it's going to cause the S&P to kind of chop around. So different when you come in and you look at your watch list and everything's green. We really haven't had too many of those days. I think we've had, maybe one day a week where you kind of look at your watch list and see everything green. And it kind of gets me to this last bullet, and then we're going to dig into the option activity. But again, wanted to give a week in review. If you look at the implied correlations, and again, I think this is always important because you want to trade where the opportunities are. So I've been showing this for a while, and whenever I give one of these week in reviews, it's kind of been the same concept for me. This is the implied correlations of the S&P 500. So names, whether or not some of the largest names in the S&P 500 are moving together, or they're moving differently. And as implied correlations, you could see this is down, is low. Again, it just means that everything is not moving together. When does implied correlations move up? I'll leave this question up to you guys. When does implied correlations start to go up? And you could kind of have a hint there. You could see in the middle of August, implied correlations moved up a little bit. Yeah, so Bob has it. When there's increased volatility, when the VIX starts going up to like around 15, everything starts moving together. And really, I don't trade the indices that much unless the VIX gets north of 15. Then I become much more of an index trader. So why do you do that? Why would you become more of an index trader when the VIX gets above 15? Because everything's moving together, and you could basically just trade Qs, IWM, small and S&P, because they're moving, right? And stocks are moving together. So until we really get back above, so I did this like maybe 1 or 2 days back in August. I was like, screw it, I'm just going to trade the Qs, because number one, they're super, super liquid. So when it's available to you and when they're really moving, you want to capitalize on things that are extremely liquid, where you don't have to pay a big bid-ask spread. But right now, it just, to me, doesn't really make a lot of sense to trade SPY, to trade Qs. IWM and Qs probably, you have maybe a little bit more edge right now, but like SPY's moving 10 basis points today. So there's just, to me, not a lot of opportunity until the VIX goes higher, and which will in turn cause implied correlations right now. So what does this mean? It basically means we're still in a stock picker's market. Now that doesn't necessarily mean that it's easy to trade stocks, because as I mentioned, you've got some that are got clobbered. And some that are doing very well. So you really have to be able to kind of spot the trends. And again, just because people say it's a stock picker's market doesn't mean that it's an easier market to trade. It just means that there's more opportunities to trade in individual stocks than it is in indices. Of course, you could be very poorly trading stocks if you're not, you know, if you're picking the wrong ones. So my little conclusion on the weekend review is, trendings, and I actually took this from the weekend newsletter. We read a weekend newsletter, and I said last week, I said, this is from the Saturday newsletter. I said, while we're currently in a choppy market, which is kind of what we were last week, I continue to look for opportunities in trending areas of the market: emerging markets, China internets, robotics, healthcare, software, and banks, which are in a downtrend, which are no longer in a downtrend. Well, are still in a downtrend, but getting better. But it's funny because I have these mentioned from last week, and you go back, and certainly they're trending. Two of the areas that I mentioned in last week's newsletter are some of the best performing groups this week. So, and I don't know how, so just to kind of just talk about just one more point about the Chinese internets, which we continue to play in the trading room. We don't know how long that trend's going to last, but and it's kind of the case with any trend, right? I mean, nobody knows. Nobody knows how long a trend is going to last. But while it's lasting, I want to participate in something that's outperforming as much as it is. What did I say? It was up 65% year to date. Who knows? This thing could be up, could be up 100% year to date by the end of the year. Or, of course, the trend could stop. So, things. So I'm going to talk about trend trading in a minute. But, once this thing, whatever, breaks the 50-day moving average, then, trends, the first, at least the major uptrend has been violated, but we're not there yet. But damn, this thing's actually really extended right now. What is the RSI on the KWeb ETF? It's 66, so it's still not that bad, believe it or not. It looks like it's getting extended to me above the short-term moving averages. Maybe it'll come back here a little bit. Maybe there'll be something that comes up in the market that'll bring us back to earth a little bit. But it's 66, not that overbought. Getting close. We're getting close. All right, so let me go over. I think I already talked about this in the beginning. Just using aggressive option activity. Need to follow a trading plan. I touched upon this because they're not going to tell you when they're going to get out of the stock. So I think I nailed this point home earlier. What do I look for? I personally look for dips. So just like we're looking at this KWeb. Right now this is not a dip, but down here. But that's basically what you kind of look for. Same thing with that Wells Fargo trade last week. Big, I think it was December and January calls that went up when Wells Fargo was oversold. Of course, Wells Fargo now, I wouldn't really call that an uptrend, but still. But that's my bread and butter. Looking for dip buying in uptrends, and especially this year because that's kind of what we have on our hands. Being picky and being consistent. So just to kind of explain what I mean by this is we see so many trades on a daily basis, and in this market where, like I said, we've got one or maybe one day a week where we're seeing where everything is green and everything goes up, and then you get a couple days of chop. So with options, it's different than sitting with stock. With stock, there's no expiration on stocks, right? But if you're trading options, depending on how far out you're going with your expiration, if you're sitting with let's say a couple positions and they expire a couple months out, you get a week of chop. You're going to lose. So that's why you have to be picky and being careful not to put on too many positions in this type of market. And again, if you've got like leaps on, or if you've got 6 months options out, you can kind of sit with positions and kind of wait for them to move, which is what I like to do a lot of the time, is just kind of sit and be patient and wait for the move to take place and then ride the trend. But if you have a bunch of positions on and a lot of them are shorter dated, odds are you're going to get snagged. You're going to have a couple days where, especially with the headlines with North Korea or, anything, it could be anything, but you get a couple down days and you're going to have your P&L is going to be miserable. and it's going to be tough to manage when you have a lot of positions on. Consistency. Be consistent with your trade size. Sometimes a trade may look awesome. It may look like the best trade. They've bought calls several times. Well, we've been in positions before and nothing happens. Like the stock doesn't do anything. So when I say be consistent, try to use the same trade size. When I feel like, and it could just be me as well, but whenever I decide to, in the past, where I've said, hey, I really like this trade, I'm going to put this trade on double the amount of size than I usually do, I seem to have bad luck with that and I get stung. I also can't stick to my trading plan because I've got a larger position on the normal, and it clouds my I get biased, so I don't stick to my rules because I'm like, oh my god, I've got this big position on, and it's starting to go against me a little bit, and then I'm not as comfortable as I am. So if being consistent, I found, because let's face it, not every trade is going to be a winner, no matter again how aggressive the trade is, how great it looks. They're just not all going to be winners. So I found that just being consistent and having the normal trade size, if you really like a trade, you can use bands as well. And you can say, hey, you could cheat a little bit. You can say, oh, I'll put on maybe 10 or 15% bigger size than I normally do. So that's one way that I kind of like keep myself grounded and allow myself to have a little bit of judgment. But something, I've really gotten away with, like, oh, I'm putting this trade on double size than I normally do because I'm looking for a home run. So, and then the other issue with that is you become glued to that position. You miss out on other opportunities because you're so concerned with the one position that you've got, more eggs than you should into the position. So, again, just something that's helped me. And then, of course, I forget what famous investor said this, but waiting for your pitch. I mean, it's not like baseball where you only get you have only so many strikes. You can sit and be patient and kind of wait. Just as long as you remain rational and just kind of like today, for example, I tried a couple small positions today, and I just said, you know what? I don't think today is. We've had a couple days, and I just said, hey, I'm going to sit on my hands for the most. Unless I see something really nice, I'm not going to play with the weekly options. That we're seeing. We saw a lot of like weekly stuff, and it's tough as well this week too because positions are expired. It's a monthly expiration too. So something that looks like it was swept and it was aggressive. It could also be that they're rolling it. It's just a little bit noisier on a week of option expiration, monthly expiration. So waiting for your, being a little bit more patient, and not chasing after everything that you see on the tape, is something also that helps. All right. So what else? So I could touch upon a few of these later. But I did want to get into some of the trades because really that's what the topic of the webinar is. So I always go off on tangents. I apologize for doing that, but I wanted to look at some trades, and I organized. Don't worry, I'll blow this up in a second. Just basically this week, and then Harrison. Then I'll go and I'll talk about the dollar. So we'll start with today. So what do we see today? So again, this is not all the trades for today, but these are ones that I just picked out. This is my whole list of today. This is my whole list of yesterday. So just to kind of look at, and that's basically what you try to do on a day-to-day basis. There's usually a list, give or take. Some days there's really aggressive call buying, and some days it's a little bit more stagnant. But usually it's a list of about 20 to 25 names. I try to keep it all on one page, by the way. Any more than that, it's just too many things to look at. So I try to keep this daily, all the day's activity just on one page and kind of weed some of them out. So if you see me display that and you're like, hey, you didn't list this trade, well, it's really difficult to list every single, trade and worry about every single trade. So again, I try to narrow it down and try to say 5 names. So what did we see today? We saw a lot of BAC. I actually mixed up the symbols today on Twitter. I tweeted out BAC and I met Baxter. I did this in the trading room today too. Somebody was like, "What are you talking about? BAC, December 60, October 67 calls." So I meant BAX. So BAX, this is a name that's pretty extended, but we just don't see a lot of option activity. And we've all known, I think everybody who's been actively trading the last week has known what's gone on with healthcare names. They've just been absolutely on fire, all kinds of call buying. And, we were making, or I was making a joke last week about it was like every healthcare name with the letter A has seen call buying. You know, AbbVie, AstraZeneca, ARRY. So I don't know what the reason was for that, but just a ton of names with the letter A, and a lot of just healthcare names we saw call buying. So today we saw Baxter calls. I did take this trade today, going out to October, right around 30 cents. It's in an uptrend. It's a little, my concern is it's a little bit extended and it's a little bit short dated, just October. But I think for 30 cents, just kind of going back to my principles that I have listed here, on a 30-cent trade for October, you kind of have to be willing to say, you may lose the whole 30 cents on it if it doesn't pop. That's just how the lower delta options work. If you're looking at something with a delta of a 30, meaning that the option price moves 30 cents for every dollar, you're going to need a big move. And I think what happened with Baxter, I didn't look at it, but Baxter ended up fine for the day, but they leaked out some implied volatility at the end of the day. So the options were back to like where they were purchased. And that's also what you have to deal with when you're dealing with front month options. A lot of times is you're subject to what the market maker, what they want to mark the implied volatility at. So I did think that was an interesting trade because we just don't see Baxter calls that much. BAC, I think I've already kind of talked about BAC, but that's really a momentum. I think BAC anyway is momentum. Yeah, I mean that's also with options that selling into strength, of course, and taking targets is different than the trend trader who owns stocks, who necessarily may not take targets. But BAC, we can look at this chart. So kind of going back to what I was talking about in the beginning of the webinar, some of these things, you have to. For me, I always try to find. I'll look at the trade that goes up on the tape, and then I'll look at the technicals. Is this in an uptrend? I'm more of a like I said, trend trader. I really don't take that many counter trend trades. Trades below the 200-day moving average. If I do take trades below the 200-day moving average, I'm usually looking for a quick bounce. So I've gotten really disciplined on that, and that's helped me a lot this year and last year as well. But BAC, you got your first MACD crossover. So yeah, I mean, I think the 200-day moving average, I think you could be long BAC against the 200-day moving average. And we've seen that's just one trade. We've actually seen about 3 or 4 different trades. This is just today's trade in BAC. I don't have yesterday's, but you can go back to my list from yesterday, and you could see shorter dated stuff. I think there was also one longer dated trade in BAC as well yesterday. But again, so they're going after BAC. So I think versus the 200-day moving average, that could be your rule. You got a nice MACD crossover. I think you could define your risk pretty easily in here and maybe go out to December, which is what they did today. So I think that's a good trade. And by the way, so if you guys have any questions, about these particular trades, and then don't worry, I'll answer the other questions. But IGT, this is a trade that they went after the last 3 or 4 days. Excuse me, not 3 or 4 days. I think it was Monday, Tuesday, and Wednesday. So 3 days. Wednesday being today, of course. which is behind us. But this is a name that, sometimes you have to have a little bit of feel, like the more experience you have. IGT's been one of those trades. When they come in and buy calls, it seems to work pretty well. And then also another point that I don't have bullet up here, but talking about waiting for your pitch, a lot of times you will see repeat activity. So if you didn't take this on the first day, if you didn't take it on Monday, you had a chance yesterday too when they doubled up. So that's another rule that you can kind of incorporate. There's all different kinds of rules that you could set for yourself to help. I try to leg into positions sometimes where I say, hey, I'm going to just basically start 1/3 of a position or a quarter of a position. Why do I do that? It could be the first time that we've seen call activity in the name. And you never know if you're going to see a repeat activity in it, like this IGT where we saw activity 3 days in a row. Also, the market, something could happen tonight. There could be a headline and the whole market's down going into tomorrow. So you could add on the weakness. What I think a lot of traders have noticed in the Tribeca trade group room is that you can get into some of these positions cheaper than what paper paid. Paper being the client or the institution, whoever bought them. So if you leg into some of these positions and not go in, I was talking about don't double. You're trying not to double up. You're keeping your position size consistent. But I've done really well where I've kind of legged into a position. I could talk about that give you a couple examples, which we saw Amazon calls yesterday. But I mean, Amazon and Google, they went through, how much time since Amazon reported earnings on 7/27. So it's been a month and a half, and it fell below the 50-day moving average, but it's basically done nothing. It's tried here a couple times to get going. So going in full steam, I've kind of been picking into Amazon here and there, thinking that, kind of waiting for this. I've been waiting, I had my alert go off today. I set an alert way back here above the 50-day moving average. And it finally hit today. This was on like 8/13, 8/14. So, you go through a whole month. And it just shows you that you have to, structure your trades appropriately. If you're going to decide to get into a trade when there's no real signal, give yourself a couple months. Like I'm in January calls in Amazon because I don't know when this thing's going to catch fire. It's basically a whole month of trading. If you went into like October trades, in October or a September trade, you would be bumming right now because finally this thing's perking up, but you probably would have lost so much on the theta decay of Amazon, not doing anything. Same thing with Google. I've been sitting long January Google calls, and I'm like, hey, I'll add to this once I get a little bit of confirmation. We're right there in Google, which we saw call buying in that one yesterday as well. But finally, these things. You had one day, but I guess this is about a week and a half ago, where it was like finally, Google's above the 50-day moving average. Well, it fell apart a couple days later, but you kind of feel like these are going to eventually wake up. But still, the 50-day moving average, I think, would be great confirmation. So, my point is, so I'm kind of giving you some of the recent trades and just talking about, principle, the best practices that have really helped me, manage positions and earn money, right? And that's what it's all about. So that's IGT. Today we also saw Starbucks. This is a tough one, in my opinion. So Starbucks, is in it is what it is. It's in a downtrend. It's below the yellow line, which is the 200-day moving average, which is a pretty ugly looking moving average. It's flat. It's really not showing any trend. But man, they hammered the hell out of Starbucks calls today. Multiple expirations. So, some of which were September weeklies, which were kind of looking for the momentum. Usually when you see the weeklies, it's like people trying to catch the momentum. It doesn't necessarily mean that they know anything or have done any major analysis. They're just like, hey, this thing's starting to move. I'm going to try to capitalize on it. So really what caught my eye was the September, was the first one that went up was April. And then they also bought some Januaries. I believe these were bought in January. It certainly was an opening trade. So how to manage this trade? If you were to take StarBucks. So first of all, personally, names that are in downtrends, it all depends on your personal style of trading. Like I said, I stick with the trend. On the counter trend trades, which StarBucks is a counter trend trade because it's below, it's now kind of in a downtrend, using the 200-day moving average as your principal. It actually looks more sideways than anything, but I would still call it a downtrend from where it's been in the last couple months. So I do take counter trend trends every once in a while. I'm just really disciplined on where I would say is where to bail. And again, I think you want to realize this every time you get into a trade, even if you went out to what did they go out to, April or January? You have to have an area that says, hey, where's the trade not going to work for me? So I think for me, I think that 5301, which is the bottom of value, that's your support. So if this thing starts to continue to go in its downtrend, that would be where I would abandon the trade. But I think, hey, I would give this a shot for StarBucks. Well, we'll see what it does tomorrow. I did not put this position on. I may tomorrow. Sometimes when everybody gets all bulled up for like a day, then the stock, then everybody forgets about it for a day or two. So these are the things that you could do. You kind of keep a running list of this stuff and realize that they went out to April. Now, who knows? Maybe there's something that's going to happen with StarBucks that makes it go up tomorrow morning or something. But, I may get a chance to actually, once things kind of cool down a little bit in the name, I may get a chance to kind of get into it. Maybe when the implied volatility gets sucked out of it a little bit. So that's my thoughts on StarBucks. I would definitely define, I think with those names that have gotten walloped or in a downtrend, have an alert set. I've talked about using alerts before. They are the greatest thing, I'll say it, since sliced bread for traders, because you could set all these alerts and then not have to like watch the damn stock all day long and just realize like, oh shit, it's breaking down and hit my alert to the downside. Or you could also wait for a confirmation for a move above 54.72, which is the value area as well. So next on the list for today, I've got Splunk listed. Why do I have Splunk listed? This has been a pretty good trade. The majority of the gains were earned on this one when they bought the September options were unfortunately all on earnings. It made a real nice move on earnings. What they did recently, 2 days ago, is they rolled out of their September options and into October. And then it looks like they've been adding to October in little pieces. So this is a name, again, this one looks tricky to me. So I'm actually looking, so I'll give you an example of what I was talking about and kind of practicing what I'm preaching, which saying that, right now personally, I don't really want any new October positions. I mentioned the one I took, Baxter. It's a 30-cent option. I'm okay with that. If I lose the 30 cents, it's not going to be the end of the world for me. Splunk is one of those names where it's kind of just been going sideways for a long time. So I'm kind of looking for a little bit of confirmation that this thing is going to move above $70. And I don't want to mess with October options at this point. So this one I may turn into a call spread. The implied volatility is a little bit higher in Splunk, which is one of my principles that I've got here. I've been doing a lot more call spreads, especially with names that have a higher implied volatility. Because as we know, I was showing the example, names with a very high implied volatility go back to my Amazon example. If we do something like this, where we just sit for a couple weeks, you're going to lose money, and you're going to on an October position, you're going to get splunked, I guess. I don't, you're going to lose money on those. So what I'm looking at for Splunk, I actually talked about it in the trading room today. I did not put it on yet. I am looking at the January 72.5 80 call spread. And another thing that I like about call spreads is I start to think about where I think the stock's going to get to, where I think it could go. And call spreads really kind of help me see that. Kind of think about, sometimes we just, you see these calls go up on the tape and you're like, oh, they must think, they know where it's going, or they must, but you try to associate a probability and say, really, what's the likelihood if that's going to happen in a month? 72.5, yeah, it could happen. Anything could happen. But it's funny that it's right at what they're doing is right at the purple line. But I like structuring. What I've been doing is kind of just using the trades that we see on the tape and then structuring my own trade, something that I'm comfortable with. And I'm comfortable sitting in a call spread for, if I pick a January option, this way I'm giving it time, to kind of realize that move from, what's the strike that I said, from 72.5 to 80. Because really what I want to do is, with that upper strike, is I want the stock to get to the upper strike. And I want to give it time to do that. All right, so that's just an example of, me structuring a trade how I want it to. And then Xilinx, I have Xilinx listed here. There's been some activity in a couple different, I talked about names that have had, or groups that have had really good trends. Certainly semiconductors have been one of them. Just looking at this, look at this on Bloomberg, because it's a little bit easier just to see the trend, I think, if you're not familiar with all the indicators that I have. So SMH, which is the semi ETF, I mean, every time this thing has kind of come in to support, has been a pretty good place to buy. So the trend remains pretty strong in the semis. So we're starting to see some different names get option activity again. So Xilinx, I actually was in calls last week. I was in weekly calls last week, and I think I hit one target, and then I tried them again on Friday, and it didn't work out. But these are why I have this down, is because I'm looking for the longer dated stuff. So January, I'm always looking for when they put down a bigger chip. That gives me more conviction when somebody puts down like $500,000 or $1 million sometimes, or the weekly stuff. Some people look at this weekly stuff, and yeah, it could be an aggressive. The trade could be swept. Meaning that that they hit all exchanges, that they lifted the offer, which is aggressive. But it could be something where it's like $30,000, the trade. I mean, that's not really going to me, that's not that much conviction, right? When these institutions are huge. So that could just be a retail investor who's doing like a $20,000 or $30,000 weekly trade. I try to weed those out as much as possible. Again, I look at stuff for ideas. So if somebody's buying weekly calls and I'll say, oh, wow, the stock could move, odds are I'm not going to trade the weeklies unless it's something really cheap. Unless I'm buying something for like 10 or 15 cents, 20 cents, and I'm not putting down a lot of my own money on it. I'm looking for a 1 or 2 day move. But most of the trades that I'm doing are swing trades. I would say my split from swing trading to day trading is probably about 65-35. Some days, some weeks 70-30. Last couple of weeks I really haven't day traded that much. But yeah, I'm looking for the bigger move. I'm not looking for like a 10-cent move for most of the time. All right, so moving on. Any questions? Any questions so far? So I know I'm already covered an hour. Sometimes I think I could go through this stuff quick, but it turns out there's a lot to talk about. So by all means, if there's any questions so far, yesterday, yeah, the JD, really got my attention yesterday. Again, just looking for ideas. I actually sold put spread yesterday on this. I've been watching JD and have had an alert on the 50-day moving average. It kind of looks like, not exactly the same, but kind of looks like Google and Amazon sitting right below the 50-day moving average for about a month after earnings. So this thing finally woke up yesterday, and I don't think I was the first to catch it. I think somebody else caught it and said, "Hey, look at JD." And I was like, "Holy cow! It's taking out the 50-day. It's climbing above the purple line, which is the 50-day moving average." And I was like, "Wow! All right, perfect. That's my signal." And I think a lot of us put on some sort of trades in JD.com, up 4.5% today. So huge winner for a lot of people. And yeah, so they bought calls yesterday. They bought some calls today as well in JD, and I think this one has more to go. I'm a little bit cognizant of this top of value 4502. Maybe it backfills here a little bit, or maybe it just keeps going. We'll see. But I wouldn't be surprised if it pauses a little bit at this top of value. That wouldn't surprise me. I do that a lot for names where the implied volatility is high. So something like, for example, I was in shop where you know, it helps me sit in positions. When you buy a call spread, it helps neutralize the implied volatility. When the implied volatility is super high, which means that the price of the options are expensive. It kind of lowers my cost basis. And I've been trying to structure things so if it's like, for example, a $10 wide call spread, I'm looking to spend, of course, I'm looking for whatever stock it is to realize the whole $10, to get from the bottom strike to the upper strike. But I really want to only invest, I've got a little formula for these things. I've got a little formula where I really don't want to go over 35% of the ultimate profits. So of course you're capping your upside with a call spread, but I'm having a lot of success trading those, especially with yeah. You want a yeah. Michael's got it perfectly. You want a 3 to 4 multiple of profits, right? So yeah, I'm looking for big winners. I'll be honest. I'm looking for things where I could sit in for a while, and if I get in for like, let's say it's a $10 wide call spread, like the shop, for example, was 290 was the call spread. The price of the call, it was a $10 wide call spread, and I got in for 290, and I got out for 970. So like that's what I'm looking for. Something where now, of course, I'm going to take targets along the way. I'm going to take a target at maybe a 40% profit or a 50% profit. I'm going to take another target at a double. And then, we'll see. I mean, not everything, it all depends on the situation. But yeah, I mean, that's basically, I'm defining what I want to happen. And it also helps me say where I think the stock could get to. So by setting that upper strike, it really makes me think about the time, how far out I want to go and where I think the stock could get to. And that's been helping me in my trading because, again, you should always be thinking about that whenever you enter into a trade, whether it's using aggressive option activity or not. You should be thinking about where's the trade A not going to work, and B, what are you trying to get out of the trade. Other than that, I mean, that's if you're not thinking about that, you're just kind of throwing darts. I think so. As you kind of perfect your trading plan, these are the things that I think about. Just like I was going through. So every time we see one of these trades on the tape, I go through this exercise. What's going to work? How probable that this trade's going to work? Are they buying 50 delta? Are they buying in the money calls? Are they buying way far out of the money? If they're buying way far out of the money calls, it's a lesser probability that the trade's going to work for you. You're going to need a big aggressive move, right? If you're going less, if you have a higher delta, you don't need as big of a move, right? And the same thing of structuring a call spread. The further you go out of call spread, the it's going to cost you less. Of course, there's a return. There's a risk return there. It's going to cost you less money, but it's going to be less of a probability for you to get to that upper strike. All right, so that's a little bit of a summary. What else do we see? So yeah, it took me a long time, but I'm getting to HEDJ, and I'm going to get to Harrison's question. So I'm not. That's one thing I'm not a big currency trader. Obviously this U.S. dollar has been in a big downtrend. I mean, is it going to get out of a downtrend? I don't know. I think a lot of people are actually starting to think bullish. To play the U.S. dollar, to go long the U.S. dollar. What I'm thinking is it going to go much lower than this? Right. So we've got some support. Actually, we're through some support. So really, really depends what you think about the dollar. I really don't have a strong view. I really don't know if it's going to go stronger, if it's going to get stronger. But I know that we do know that it's made a big move. This is the UUP ETF, by the way. You can look at this per currency, or you could look at this like if you want to look at the euro, because HEDJ is mostly the euro. Or it has exposure to the euro. I do know that with the euro, it has taken out of VPOC, and it's kind of come in here a little bit. So what I would say for this is, it depends what your thoughts are on the currency, but I know that somebody has taken this trade. Sorry, I don't want this. I don't want this up. I want this. So HEDJ yesterday. So why do I like this? Well, it's not just a week. It's not a weekly option. It's not front month. Front month. It's November. So this was an opening trade yesterday. Again, what is HEDJ, which I covered in the beginning of the webinar, but it's a basket of European stocks. There's no currency exposure. So even if the dollar or the euro stops going up and European equities continue to go up, then this trade is going to work. So I like this trade. It's bounced on the 200-day moving average, and it's targeting around 65, which is funny because I've got a VPOC up here. I've got a version point of control. So I like this trade very much. I did not put this trade on yet, but I've been contemplating it. Maybe I wanted to talk about it at the webinar first. So that's a trade I have not put on yet, but I'm definitely eyeing. I do have exposure to Europe already. These are my cash positions. So I've got exposure to Europe already, but I'm looking to kind of add some exposure in options. And then just a couple. I think we kind of covered most of these trades, but you could see a couple trades I highlighted from a couple days ago. Applied Materials, which they've done a couple times. I think Applied Materials can continue to run. I talked about IGT already, which we've seen multiple times. I've got it up here as well. And then JBL. I've got this one listed here because they went out to December. So again, I don't have this position on right now. I've got an alert. I want to see this thing kind of come out of range. Maybe right above 3160. I think I was to put an alert on 3160 or 3165. So, that's another thing that kind of keeps me grounded a little bit with not taking too many positions. I'll look at things technically, and sometimes if I just put an alert on it, like I feel like, hey, I'm going to catch it if it starts to move. And then I'm going to say, hey, I've got an alert on for JBL, and I remember that they bought December call options, right? So, that's kind of how I've been managing things and trying not to take, managing myself, not putting on too many positions. Yeah, the maybe time, and that's kind of what I'm thinking. Most of my positions, Harrison, that I've got on that have been working really well in cash, they've got a lot of, you're essentially short the U.S. dollar. If you're long Brazil, EWZS, if you're long EZU, if the dollar really starts to rage, you're going to get caught. not to say that they're going to depreciate, but it's going to be, like I said, it's additive with the international ETFs. If unless they actually hedge the currency, it's additive. So you need the stock to go, the basket of stocks to go up, and you need the currency to go up. All right. So any questions? I think I covered most of what I wanted to cover, which is again, it's a lot. It's a lot. So thank you for kind of bearing with me for a whole hour while I went over a lot of the principles that I look at with trading options. I'm going to talk. I'll talk a little bit more. Again, I probably bit off more than I could chew with two subjects, but every trade that I look at, I make a decision whether or not I want to put it on cash or whether I want to put it on an option. So sometimes, just like I mentioned, I should have it in here someplace. I don't think I do. I guess I don't have it in here, but yeah, but basically, you. Thank you. Thank you. That's very kind of you. But basically, like I'm looking at every position, every signal that we see in terms of option activity, and I'm saying, will this work better in cash or will it work better in options? And then, if it makes sense, if it fits my system, I've been doing a lot of cash trading, where especially for stocks that are like under $30, $40. Even more so for stocks that are $20. Oftentimes we see options in like a $12 stock, and you stop and you think about it, or sometimes even under a $10 stock. It's like, first of all, why are they buying options? And it puzzles me why they would buy options in like a $5 stock or $6 stock. But you basically could just buy the stock and not deal with, like let's say it's a $12 stock. You just buy the stock and not deal with the expiration, the theta decay, the implied volatility. So what I do for cash, so this is a good question, and this is kind of what I wanted to go into for trend trading. So I've got two portfolios that I manage. I just started this one on 315. You can see my performance it's pretty good. It's better than the S&P. I think the S&P is only up about 4 or 5% since 315. I have to double check that because it may have gotten up maybe closer to that. But basically what I'll do is I'll look at position size. And this is the first year that I've ran this. So, my risk, this is risk adjusted trade size. So I'm basically using the stocks, I'm using a volatility concept, which is ATR. So I'm looking at the average true range of the stock. So for instance, BZUN, I only have a 100 lot on. So why do I only have a 100 lot? Because the ATR of the stock is $2. That's how much the stock moves. And believe it or not, I only have a 100 lot on, and I'm up $1,000 in the trade. It's gone up 37% since I put the stock on. And that's been one of my nicer recent trades. And I'm riding the trend. And this way I don't have to, so we've been seeing call buying in BZUN recently. But I don't have to worry about, the crazy implied volatility. So I'm risk adjusting it with ADR. So I do this every trade. When I send out trade alerts, I talk about, first of all, every time I send out a trade alert, and you can see because I've got a channel for this. So for example, I just got into Twitter the other day. Every one of these, so this is a trend trading concept. I know exactly where my stop is. I've got it set. That's why it's systematic, because if you see here, this is all formula based. You can see the formula up here, and I've got it all plugged into formulas using Bloomberg, Bloomberg Excel function. So for Twitter, for example, which is my last entry, which started to look good today, and then it kind of came back. Looks like I'm up $100 in this one. But my stop is the 200-day moving average, which is $17, and I'm using 1.5 ATRs below that. So a little bit. So I've got just so there's not, sometimes there's whipsaws around moving averages. So I put my stop a little bit below, give myself a little bit of tolerance for that. And my size will be based on, so basically it's adjusted. It's 100,000 account size. So I only really want my position sizes to be about 2% per position. And then I drill down based on what the ATR is. So I'll take $2,000 divided by the risk adjusted price. So that gives me around 220 shares. I actually went a little bit under for that one because I just so the whole idea of trend trading, which again is another subject, is to be as unbiased as possible and to basically just say, hey, here's your entry, here's your signal, and I'm going to sit with this trade for as long as it wants to run until it breaks support. So I may adjust. So some of these I adjust if they really start to run. I'll take some of the trade off. I'll tighten up the moving averages. So let's say Twitter begins to run. So I did this with Fold, for example. Fold I got into on the 200-day moving average. This has also been a great trade. And my stop was the 200-day moving average because that's what got me into the trade. However, it's been extended. The 200-day moving average is all the way down here. I don't want to lose all these profits. So if it breaks the 50, so I think I've ratcheted that up for Fold. My stop price, so I've got this pegged to, actually I have it pegged to the 20-day moving average. The 50's down at 1290. And as long as it's going to stay in the trend, I'm in it, and I'm not going to do anything. So it really kind of takes your personal judgment out of it, and that's why it's systematic. So I don't touch these, even though I'm watching some of these. It's kind of painful watching a couple of these trades that I got into, like GDX was a big winner, and it's kind of coming back in this week. And I think the stop I have for this one I probably should have. I did ratchet it up. I got in on this one on the 200-day moving average in GDX. And I'm using the 20-day moving average, which is not pictured here, which is still far away. Oh, no, it's right here. That's the blue line. So my stop is going to be 1.5 ATRs below. Uh, 1.5 ATRs below, which gives me a price of 23.30. And the 20-day moving average is $24, so that's why I've got that on there. So this way, if it does break, I could lock in. So I've been experimenting with this system that I've been doing since March, and I've been getting much better at it. Also, taking half of the position off before earnings has helped me a lot. I've had a couple big losers that I've held into earnings. So the decision that I've made is to take half the position off before earnings, and that's really helped a lot. Because it stinks when you have a big winner turn into a big loser. So any questions? So yeah, so I've been doing that. So I'm going to plug for a minute. To be a member of Tribeca Trade Group. This is what you get for the first 6 months. For the first month, excuse me, half off the first month. So we do a little bit of everything. We do, if you're both a day trader, we've got plenty of day traders. Like I said, I still day trade. I just don't day trade as much. Probably it's about 30% of my trading, I would say. I'm really doing a lot more swing trading and trying to hold, because it is what it is. I'll change. I change with the market. So I'm not a perma bull. I'm not a perma bear. I will change as the market changes. And right now, most of the markets globally are trending. So I want to stick with so why capture little profits? So that's why I'm doing less day trading. So, again, you go back to emerging markets. EEM, which is one of my biggest positions. I don't want to go after little tiny profits. I want to stick in this trend for as long as as long as I've got my stop. Actually, it's not that big of a position for me. It's only 7% of this portfolio. So it's not that large. Well, yeah, I mean, then we're getting a little bit, it's a little bit hard for me to manage that philosophy. I mean, it's difficult because options are going to have that high implied volatility, but I also don't want to incorporate options into this portfolio. I want this portfolio just to be cash, but you got a point there. So, that's things, if you're following along with me, that's things that you can make a decision on, but I want to just stick to my rules. And that's been working pretty well for me, taking the half off. So I haven't really had any complaints with doing it that way. From what I've noticed since the last earnings cycle, you could see I've got that built into, so this way I don't get caught. Can't believe we're going to be we got earnings coming up next month. Yeah, that's the whole thing. I mean, I'm conflicted by that with what Michael's saying. I mean, I just don't like where you could have a big winner and it turns into a big loser. So the half off has been helping me kind of with that decision. So, any questions? Happy to go over. If you guys have questions about this portfolio, because I don't go over it every day. If you have any questions about this portfolio, any questions about any of the other topics that we covered, certainly go ahead and ask away. But would love to see you guys try the room out for a month for $69, because even if you're a part-time trader, the newsletter that Pat and I write on the weekends, Pat does a great job at picking stocks to watch for the week. Some really good stuff. A lot of stuff that's off my radar. Some really good trade ideas that he puts together. A lot of times Pat looks at smaller cap stocks, and then the newsletter that I put out is mainly a macro newsletter, really looking at the bigger trends that's going on. Of course, you get my fund flow report on where money's going into. I'll tell you, we've caught some really good trades off of watching fund flows. The K-Web was one, the robotics, all the money that went into robotics this year. These ETFs, the Robo and I would have never found these ETFs if I hadn't seen, all the money that was going in the beginning of the year. So that's it. Any questions? If not, we'll call it a night. An hour and a half, not that bad. I think last two webinars we gave were around 2 hours. I blame Web for that, by the way. All right, cool. I don't see any questions. Yeah, please join. So TribecaTradeGroup.com. My new office, by the way, is I'm right on Wall Street at WeWork. So you could go to products here. Make sure you use coupon code TTG for half off the first month. But again, you get such a huge value. If you're a serious trader, part-time, full-time, I don't think you're going to find as much comprehensive information that we put out, as well as trades and the type of trading we do. So thanks everybody for joining me for tonight. And I think next week, since I talked so much about international ETFs, I might just do a whole webinar next week on what's going on internationally and just kind of really dig into a lot of details, a lot of different ETFs, a lot of different trends. One that I found, this is not international, but one that I was looking at today, seen some really small inflows. This is like 15 million bucks, so it looks bigger than it actually is. But this move looks like it's already taken place. But maybe on a pullback. What's interesting as well this is the rare earths ETF. Scale this out. Look at the 5-year, and it may just beginning the trend. So I'm really interested in this. This is on my radar now. Maybe a pullback if I get a pullback to the 50-day moving average, I would be all about starting a position in this thing. Maybe even to the 20 at this point, because it looks a little bit extended here. Lit's another one. I feel embarrassed that I do not have a position on in this one, but what a move in this one. And there's been guys in the room that have been all about this. I know Harrison's been talking about this one. GB's been talking about this one as well. So really a huge move this last week in this. But this one also, some of these, they're pretty small funds. So you have to really pay attention. But look at all the inflows. Again, this is money going in. This is fund flows, actual money going in, which is only available on Bloomberg. But man, look at all the money that's going in since the beginning. So this is a 5-year chart. If I back this out for the last year, it's really accelerated the money that's gone in and the volume. Of course, the volume is the flows are from the buying. So, all right, great. Well, thanks everybody for joining me, and have a